Hey everyone, imagine this for a moment. What if the biggest winners of the artificial intelligence revolution are not the companies building flashy AI models, but the companies quietly supplying the power behind them? What if, instead of spending billions on their own supercomputers, businesses could simply tap into AI power whenever they need it, turn it on, scale it up, and shut it down like electricity? And here's the real question investors need to ask. When a company's revenue is exploding this fast, does it actually justify burning through cash at an equally shocking pace? That question takes us straight into today's story, Nebius. Because Nebius isn't trying to be another app, chatbot, or consumer AI brand. They're doing something much more fundamental. They're building the infrastructure layer of artificial intelligence itself. Massive GPU clusters, cutting-edge NVIDIA hardware, AI-first cloud systems designed to handle some of the most demanding workloads on the planet. Demand is surging, revenue is climbing fast, but losses, they're growing just as aggressively. And that tension between explosive growth and heavy cash burn is what makes Nebius such a fascinating company to analyze right now. Nebius Group came into existence after the restructuring of Yandex's international assets. Headquartered in Amsterdam, the company now operates independently and serves customers around the world. What separates Nebius from traditional cloud providers is focus. This is not a general-purpose cloud built for emails, file storage, or basic applications. Nebius is an infrastructure specialist. Their cloud platform is built specifically for data-intensive and AI-driven workloads. Businesses that need enormous GPU power, fast CPUs, ultra-low latency networking, and high-speed storage don't go to Nebius as a convenience. They go because they need serious performance. Instead of companies owning and maintaining their own AI supercomputers, Nebius lets them rent access to massive compute hubs packed with top-tier NVIDIA hardware. That means customers can train models, run inference, and deploy AI systems without dealing with the cost, complexity, or risk of managing physical infrastructure. In simple terms, Nebius builds the digital factories where AI is trained, tested, and refined before it ever reaches the real world. Behind this platform is a global engineering workforce spread across Finland, Serbia, and Israel, supported by hundreds of specialists in high-performance computing, data center design, and AI tooling. This isn't a lightweight software operation. It's heavy infrastructure combined with deep technical expertise. Now let's talk about what's been happening recently. On December 17th, Nebius rolled out a major update called AI Cloud version 3.1. This launch added NVIDIA's latest Blackwell Ultra compute systems to the platform. Specifically, Nebius deployed HGX B300 and GB300 NVL72 systems, becoming the first cloud provider in Europe to offer this level of hardware. That's not a small milestone. Along with the new hardware, the update introduced real-time GPU capacity dashboards and upgraded developer tools. These changes make it easier for customers to plan workloads, scale training and inference, and deploy AI products efficiently. It reinforces Nebius's identity as a premium AI infrastructure provider rather than just another cloud utility. Now, let's look at the financials, because this is where things get intense. In its third quarter filing, Nebius reported revenue of $146 million. That's a 355% increase compared to the same quarter last year, when revenue was just over $30 million. Growth like that is rare, even in the AI space. But profitability is nowhere in sight. Net losses widened dramatically, reaching approximately $120 million, compared to around $44 million a year earlier. Cash burn has accelerated, and while that spending isn't random, it is aggressive. Most of it is going toward expanding infrastructure, increasing AI capacity, and laying the groundwork for long-term growth. Nebius has also signed a massive 5-year, $3 billion AI infrastructure agreement with Meta. Alongside that, the company established an at-the-market share program that allows it to sell up to 25 million new shares over time to fund expansion. This tells you exactly how management is thinking. Nebius is choosing long-term dominance over short-term profits. For investors focused on income or near-term earnings, that strategy can feel uncomfortable. But for growth-oriented investors who believe AI infrastructure demand will keep rising, the approach can make strategic sense, assuming execution stays strong. But the future of Nebius isn't just about today's revenue numbers. It's about what they're building next. In November, the company brought a new AI infrastructure facility online in the United Kingdom. This site was designed to deliver supercomputer-level performance while remaining energy efficient, something that matters a lot as AI workloads grow more power-hungry. This facility removes a major barrier for businesses. Companies no longer need to spend enormous amounts of capital building their own supercomputers. Instead, they can simply rent AI capacity when they need it. Even for companies that could afford their own infrastructure, renting often makes more sense. Nebius handles maintenance, security, upgrades, and optimization, while customers get fast processing, low latency, and reliable performance without owning any hardware. Early adopters in the UK include life sciences companies like Basecamp Research and Primate. These organizations use AI to accelerate research, improve drug discovery, and analyze highly complex biological data. Having access to powerful local AI infrastructure allows them to work faster without risking sensitive data or facing delays. By placing data centers in major international hubs, Nebius enables regional access to elite NVIDIA-powered computing resources dedicated entirely to AI development. On top of that, Nebius has developed something called a token factory. This is a large-scale system designed to make running AI models cheaper and more practical for real-world applications. Businesses can take open-source models and refine them into customized tools like chatbots, search systems, or internal AI assistants. Because all of this runs on high-performance NVIDIA hardware, customers get stable, high-speed AI performance without owning any infrastructure themselves. But as exciting as this all sounds, the risks are just as important to understand. Despite revenue growing at an incredible pace, Nebius is burning cash even faster. Operating cash losses have roughly doubled year over year. That means the company is spending money faster than revenue is coming in. In an ideal scenario, strong revenue growth eventually leads to improving financial stability. But when every additional dollar of revenue is expensive to generate, the business becomes increasingly dependent on external funding. That introduces dilution risk and financial vulnerability, especially if capital markets tighten. Nebius is also investing heavily in buildings and equipment far beyond its current revenue base. These assets create high fixed costs that must be covered regardless of demand. If AI demand remains strong, these investments could generate significant future returns. But if demand cools or pricing weakens, the company could be stuck with extremely expensive assets producing lower than expected returns. Right now, these investments represent roughly 6 times the company's quarterly revenue, which puts enormous pressure on execution. There's also supplier dependency to consider. Nebius relies heavily on NVIDIA hardware to power its infrastructure, including the newest UK deployment. That relationship works well today, but it also creates exposure. Any disruption in NVIDIA's supply chain, pricing, or roadmap could directly impact Nebius's operations. So how is the market reacting? Nebius stock currently trades around $87 per share, giving the company a market capitalization of roughly $20 billion. The 5-year beta sits near 3.8, which tells you this stock is extremely volatile. It tends to move almost 4 times as much as the broader market. Over the past month, shares are down around 7%, but zooming out changes the picture entirely. Year to date, the stock is up more than 200%, and over the past 12 months, it has gained a similar amount. Analyst sentiment remains cautiously optimistic. Among 8 analysts, the consensus rating is a moderate buy, and that rating has remained stable over the past 3 months. The average score has ticked slightly higher, and the highest price target sits above $200, suggesting significant upside, if everything goes right. So the big question remains, is Nebius building the backbone of the AI economy, or is it moving too fast, spending too much and assuming demand will stay red hot forever? That's what investors will be watching very closely. Because in AI, the companies that control the infrastructure don't just support innovation, they enable it. And if Nebius executes well, it could become one of the most important players in the entire AI ecosystem. But the margin for error is thin. And that's what makes this story worth following. This is not financial advice.